Hello, I'm Nathan Kubik, and thank you for joining us for the 2020 Year-End Transform Wealth Capital Markets Outlook. I hope that everyone is doing well and staying healthy. Many of us are back in the office, though we are continuing to social distance and will continue to have virtual meetings. Our dedicated team continues to serve you with the exact same efficiency, systems, and tools as we have in the past. In this outlook, we will be focusing on the current market conditions, economic impacts from COVID-19, the market's response, what lies ahead of us, and how we are positioning. So let's get started. In the last quarter of the year, the equity markets continued their rally, with the S&P 500 and Nasdaq reaching new record highs. Forward-looking economic indicators are continuing to improve. Corporate earning levels are also improving and are forecasted to continue this trend. With the vaccine rollout already underway, 2021 looks promising from an economic standpoint. However, there are many unknowns related to this virus, to the political unrest, and there are some areas of the economy that do have a long road ahead. In this outlook, we will be diving into what we find to be the most influencing factors and what those mean for where we are today and where we go from here. Looking back at 2020, I know we are all anxious to move many parts of this chapter in our lives. The COVID-19 virus represented the epitome of a black swan event, one that took the world by surprise and shut down the global economy in ways never before seen. A subsequent recession ensued, but with decisive action taken by the Federal Reserve and U.S. Treasury Department, the economy very quickly stabilized and began its road to recovery. We have witnessed the shortest recession in history and have seen a truly remarkable market recovery. Most recently, the attention of the markets has been focused on political uncertainty and unrest. This focus, combined with the underway vaccine rollout, has resulted in the COVID-19 virus not being quite so much in focus. It is important to understand that while there are certainly reasons to be optimistic, there are still risks ahead related to the virus. Confirmed cases and fatality numbers hit a new high in December and have done so again in January. New variants of the virus are appearing, and while initial studies show the vaccine to be effective, the long-term impact of future strain variants is an unknown. Additionally, there are hurdles related to the distribution of the vaccine. Here we consider the first three phases of the vaccine rollout. We spent a good amount of time of looking at different estimates for each of these phases, and while there is direction, there are not yet specifics on dates. The distribution systems are currently being built out, and we are optimistic that this will continue to ramp up in a meaningful way. The Pfizer and Moderna vaccines are showing 90% effectiveness, and we are encouraged by the expectations for the Johnson & Johnson vaccine. The results of the Johnson & Johnson Stage 3 trials are expected in the next couple of weeks, and if those are effective, we will have the ability to piggyback the new distribution systems without the tough refrigeration requirements and with the need for only one shot. As of now, we are targeting a late spring or early summer availability for the masses. This expectation of life returning to a semblance of normality has created a very high level of confidence in the U.S. markets. Here we look at investor sentiment as depicted in blue. As you can see, sentiment is charging higher. Alongside that is the amount of money individuals are borrowing off of their investment accounts. Or in other words, people are using margin or debt to invest in the markets. The red line here represents the amount of debt that is being used by individuals to make investments. This chart depicts a quite high level of confidence in the financial markets. And this is supported by earnings estimates put forth by the consensus of analysts. Looking at the section of this chart in light blue, we see the dip in earnings as a result of the virus in 2020, which is the first blue column. But we then see earnings estimates jumping in 2021 and beyond. These estimates, along with positive economic expectations and furthered by the current interest rate environment, have been directly responsible for much of the equity market's rally, and in turn, the high valuation metrics we are currently witnessing in the US markets. Here we consider those valuation metrics. As you can see, the market is overvalued based on the historical relationship of current market values and that of projected earnings over the next 12 months. But as we saw in the last chart, those earnings are expected to continue to grow, and that too is priced into the stock prices. These metrics do continue to concern us, and we do see some areas of higher risk within the stock market. We are also concerned about the implications of possible changes to corporate tax rates under the new administration. That said, we also continue to see areas of opportunity, and we believe there is a meaningful disparity within the relationship of risk and return within specific stocks in the stock market. And here we consider that disparity. The green line represents median price to earnings ratio for the S&P 500 companies. The gray area represents the range of the price to earnings ratios in all companies at S&P 500 after eliminating the top and bottom 20 percentages. As you can see, there is an incredible range right now, a range not seen since the tech bubble. We believe this disparity creates a meaningful opportunity for our active management investment approach and for individual security selection as a whole. Another area in need of consideration is that of government spending. Early in the crisis, the CARES Act infused $2 trillion into the economy. At the end of the year, another $2.4 trillion was approved for infusion. Looking at the charts on the left, we see this jump in government spending and the increase in federal debt. Additionally, based on Biden's proposals, we should expect to see another $5 trillion infused into the economy over the next decade. Expectations are that this will create another $2 trillion deficit. These infusions are a double-edged sword. On one hand, the infusions should stimulate short-term growth. On the other, the mounting federal debt and future liabilities does create a problem that will need to be addressed at some point down the road. Now, from a long-term perspective, we would argue that the U.S. approach to COVID has turned out to be more thoughtful than that of the rest of the world. As you can see in the chart, the spending and revenue focus of the U.S. is meaningfully different than that of the rest of the world. And this focus is appearing to have been more effective. Corporations were forced to pivot and thus are seemingly better positioned today to continue to drive the economy forward. Yes, there was a much greater impact from an unemployment perspective. However, the better positioning of the U.S. companies who successfully pivoted has led to a sharp decline in that unemployment. And as the vaccine is rolled out, we believe we will see this difference in trends continue. This difference can also be seen in the rebound in corporate earnings. Here we see the difference between the rebound in U.S. earnings in blue and that of the rest of the developed world as depicted in orange. The U.S. appears to be rebounding at a faster rate than that of other countries. And this directly correlates to the performance we are seeing in the equity markets. The rebound in equity market values is greater for the U.S. than the rest of the world. We continue to watch the rest of the developed world for signs that it may be time to add some exposure. But at the moment, we still find the U.S. to be better positioned moving forward. From a style perspective, we have seen large growth companies continue to dominate the equity markets. For 2020, large growth outperformed large value by 32%. Additionally, in the fourth quarter, we did add some small cap exposure. Small cap stocks had a tremendous run, moving up over 25% in the fourth quarter alone. Within the small cap space, growth also outperformed value. Now, we have been overweight growth in the portfolio for most of the past decade, which has been great for us. But if you remember from past market outlooks, through this pandemic, we believed we had found an opportunity where companies with growth characteristics were inappropriately being awarded a value assignment based on their valuation metrics. We believe that those companies were being unduly penalized, and we added exposures to some of these companies. Well, based on this year-end style box assignments, it appears we were correct. There were 12 companies in our core equity model that were reassigned to a growth year style box. In other words, their growth characteristics were rewarded by the markets, and their increase in market valuation pushed them to a more growth-oriented style box. Looking at the top center box, we see our style positioning at the previous quarter end, what appears to be a value tilt. However, in the top right box, which is this year-end positioning, this shows us that without making any meaningful style repositioning moves, that our belief of in fact being growth tilted was indeed correct. This rewarded positioning was one of the attributes that led to our outperformance this past year. Another contributing attribute is that of our sector weightings. Technology, our largest overweight, continues to be the top performing sector. This was a particularly tactical year for us. There have been a number of sector moves we have made to take advantage of market dislocations, and we feel proud of the way we stepped into those dislocations and the way we were rewarded. Growth-oriented sectors continue to outperform that of value-oriented sectors, and we believe sector positioning will be an important attribute moving into 2021. Here, we look at our core equity model. Technology, materials, and financials are our largest overweights. I will note that we moved financials to an overweight after the sector was decimated with memories of the financial crisis. The sector has since rebounded in a significant way. Moving into 2021, we continue to focus on sectors that appear to be better positioned than others for this coming market cycle. Additionally, we are focusing even more closely on the subsector weights and individual securities fundamentals. A similar story can be seen in our dividend equity model. Technology, discretionaries, materials, and industrials are our overweights here. This strategy has an inherent tilt towards large cap value, and this attribute did drag on the portfolio through 2020. That said, we believe these types of companies have stronger fundamentals and their valuation metrics remain relatively attractive. Like the core equity model, we also continue to hold a defensive portion within this model to the buffer cap strategy as well. As we are in a time of incredibly low yields, the dividends associated with these companies, along with their strong fundamentals, should continue to look attractive and entice buyers as we move into 2021. And in regards to those yields, here we see the U.S. Treasury yield curve. As the future has brightened, so too has the yield curve risen a bit. While we remain at extremely low levels, there has been some movement over the past quarter. At the end of the third quarter, the 10-year was at 0.68% yield and is right now at 1.15%. While that's nothing to be ecstatic about, there are reasons that the longer end of the curve may continue to creep upwards. The pressure of much of the developed international bond markets issuing debt with negative interest rate does continue, and Fed Chair Powell has set forth the expectation of low interest rates for the next 2 or 3 years. Now remember that the Federal Reserve controls the Fed funds rate, or the very short end of the curve. In fact, the Fed funds rate is the overnight bank borrowing rate. As you can see in this chart, both the Fed and the market expect this rate to remain near zero for the foreseeable future. This bodes well for the equity markets, but does limit the likelihood of interest rates rising for bonds. But remember that in addition to controlling the Fed funds rate, the Fed, along with the U.S. Treasury Department, has been purchasing debt securities to stabilize the bond markets and to artificially hold rates low. And here we see the tremendous buying of the Fed over the past year. While the massive levels of buying have diminished, the Fed is still supporting the bond market and pushing interest rates down. At some point, the Fed will need to stop buying and begin selling off some of these bonds from their balance sheets. Here, we look at the Fed's balance sheet. As we can see, there has been an enormous expansion. This has reduced the supply of bonds in the market, and assuming relatively constant demand levels, this has in turn pushed up bond prices and pushed down bond yields. Eventually, the buying will stop, and the Fed will begin selling into the markets. Of course, they will be thoughtful about this selling, but as our country's debt continues to mount, and as the economy begins striding forward, the Fed will eventually begin lightening their balance sheet. It is our hope that this will move the longer end of the interest rate curve and offer us an opportunity to step into more attractive yields. Of course, this is an unknown, but with such a flat curve and in a low yield environment, we feel strongly about our current positioning. And we believe that right now is an incredibly important time for both patience and thoughtful positioning. We hope this presentation has been helpful in understanding some of the market's moving pieces. We also hope that we've been effective in showing you some of our underlying rationale for our current positioning. In conclusion, while we are encouraged by the improvement in economic data and forecasts, there are still many unknowns, and we are positioned with that in mind. Each day brings us a little more clarity and one step closer to getting through this difficult time. We remain focused on potential risk exposures and are prepared to reposition again should clarity of information shift risk exposures further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us. Please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, please stay safe, and we look forward to speaking with you soon.